AP Capital. I'm happy to have Ches Hagen on the line with us tonight. Ches, how are you doing?
I'm doing great, Peter. Thanks for having us.
There you go. We did this webinar about a year and a half ago, and we talked all about investing in AP Capital and what it meant to be investing into a mortgage investment corporation, et cetera. And, Ches, I found that over the course of the past year, I've still had a lot of people get confused because out here in BC, of course, we have a mortgage investment corporation is a common investment if you're looking at investing into mortgages. Back in Toronto, Ontario, other provinces, people are more accustomed to direct private lending one-to-one or investing into a syndicated mortgages. So I thought tonight, let's just jump right into it. And by the way, folks, when you're looking at mortgages, I mean, a lot of it, probably everybody on this call listening to this has at one point or another in their lives either has a mortgage or at one point you've had a mortgage. So you understand the concept of paying to a bank. What we're talking about is the opportunity to be on the other side of the desk, and you are effectively like the bank. You're the lender, so to speak, and you can invest your money into mortgages. So there's three types of lending that are out there. There's the bank that lends money out on mortgages, and there's private individuals who lend one-to-one. There's syndicated mortgages. But then there's another entity called the Mortgage Investment Corporation. So I want to make sure that everybody who's listening to this tonight has a very clear understanding of what it is when we talk about AP Capital MIC meaning Mortgage Investment Corporation. What is that? So, Ches, why don't we start with that?
Sure, that's a question that I can, kind of delve into. In 1973, the federal government in Canada actually added to the Mortgage Act the Mortgage Investment Corporation. So essentially allowed for Canadian entities to form a corporation called a Mortgage Investment Corporation. And, that's a mouthful, so people shortened it to just MIC. And MICs were formed. Now, of course, private individuals or companies had to kind of start them and form them and generate shareholders. And so that has happened over the last number of decades. It's happened, as you mentioned, more so in British Columbia than it has happened in other provinces. It certainly has happened in all the provinces, but it's been quite popular in British Columbia. But essentially, to kind of simplify it, a mortgage investment corporation is a corporation where there's shareholders, and those shareholders, their funds are pooled together into a single fund, and then that single fund is lent out to borrowers. The MIC, as it is, runs an underwriting team with an administration team to essentially locate mortgages, underwrite them, discard those that they do not like, manage them on an ongoing basis, collect monthly payments, deal with borrowers that are challenging, deal with lawyers, deal with all the stakeholders in the path, and really run a full operating mortgage business, much like the banks and trust companies in the country. But we don't, as a MIC, we do not have checking accounts. We don't have physical branches. We don't offer credit cards and different types of lending. We do one thing and one thing only, and that is we lend on in mortgages.
Well, okay, so this is really good to create this clarification and distinction. And again, folks, what I'm trying to do is really make a big, huge, significant distinction between lending privately one-to-one, lending in a syndicated versus investing into a MIC. So, Ches, help me understand this. If I'm an investor, I'm a real estate investor, I'm just looking to put money in my TFSA or my RSP, and I would give you, let's say, $50,000 to invest into the MIC. Now, this is very different than deciding to go on title on a mortgage, for example. Can you walk me through what that process is if I invest into your company?
So you invest in our company much like you would in other private company investments, or private equity as the term is commonly used, which isn't very far from investing in a public equity, except that as a private equity firm, we're not traded on a TSX stock exchange, but rather somebody would buy securities, buy shares, become a shareholder in exchange for their TFSA investment. They receive a share certificate in exchange, no different if they were to buy a bank stock on the TSX. There is a liquidity difference, and we'll get into that in our webinar, I know. But essentially, they then are a shareholder. Their funds are in the pool of funds along with the other shareholders. So at AP, we have close to 1,100 shareholders. So my $50,000 TFSA would be there in the same pool along with, 1,000 other shareholders. And then the MIC uses that pool to place mortgages on title, no different than one of the Schedule I banks would place a mortgage on title. And so here I am as a shareholder. I have a share certificate from this mortgage investment corporation. That mortgage investment corporation is on title on many different properties, and I'm a shareholder of it. So different than that one-to-one you talked about.
Yeah, well, exactly, because somebody emailed me the other day and they said, I'm interested in investing in AP Capital, so do I need independent legal advice, or how do I go on title? I'm in Ontario, so if AP Capital is lending money on Vancouver real estate, do I need to fly out there and do an appraisal on that property and talk to my lawyer and be on title, et cetera, et cetera? And the answer is no, because you're not being registered on, when you lend your money or you invest into AP Capital, you're not going on title against a specific property. You're investing into a pool, and it's AP Capital that actually is on title, correct?
That is correct.
So this is really important to make those distinctions, and we're going to circle back to that. But first, let's talk about why somebody would be interested in doing this in the first place. I know if you've got a mortgage from a bank right now, you're probably paying at or below 3% interest rate. What would be an expected return to an investor, what we would call your targeted return? And maybe you can explain what you mean by targeted return. But first of all, let's just talk about what some of the expected returns could be if you were an investor into AP Capital.
Sure. And Peter, if I can, I just want to advance to the next slide, which just talks about a disclaimer, because as we get into some of the more detailed questions about the investment in a mortgage investment corporation, certainly what we're going to go over this evening is a lot of the high points that touch on the questions that many people do have. But this presentation and this webinar is really a marketing session, if you will, and it will not disclose all elements of the investment, including the risks and so on. We'll be talking about them, I'm sure, but really we raise capital in this country of Canada using what's called an OPRI memorandum, and that outlines all the details. I know that investors are always provided with the OPRI memorandum, and it should be relied upon. So with that, let's continue on. And let's answer your specific question there.
Absolutely. Thanks. I forgot to do the disclaimer, and that's always very important. So, and again, further to that, if anybody is interested in investing after listening to this webinar, please contact me directly so we can do a gap analysis, analyze and make sure that any investment you do is right for you and suitable, and that we understand what your needs are, and that you've had a clear understanding of the offering memorandum, et cetera. So back to my question, Ches, you talk about targeted returns of what someone's expectation would be. So let's, maybe you can elaborate on that for us.
Sure. So we talk about this targeted return. It essentially is what we wake up in the morning aiming to achieve for our shareholders. And over the last 3 to 5 years, we've been always shooting for this 7% or better, 7% per annum as a return to our shareholders. And they can elect to receive that monthly in the form of cash or monthly in the form of additional units. We've exceeded that target of 7% since we started 10 years ago. I have a chart coming up in a few slides that shows the sort of the 9-year trending of returns from our fund. But we're, so oftentimes the thought is, well, how can you achieve a 7% return to your shareholders when I can go talk to a major bank today and get a mortgage for, 3% or 3.6%, or, obviously over the summer we saw
you just stole my next question.
So the real big point there is that as a mortgage investment corporation, we are a short-term lender. We do 1-year term mortgage loans. We're not the 25, 30-year term lender that the conventional banks are.
Excellent. Okay, so we've established two critical components here. First of all, when you invest into AP Capital, you are not going on title on a mortgage. You are not investing directly to one individual. You're putting your money into a pool, and AP Capital, much like the banks, has a pool of money that they invest on your behalf. And how many mortgages? Well, first of all, how much money do you guys have in total right now?
So we've raised $60 million of investor capital over the last decade, and that's what's in the fund today. We've probably invested or raised north of that, but there's been situations where people have asked to receive their funds back. We fulfill redemption requests, of course. We also have a credit facility with our bank, which is HSBC. So we have a lending capacity today of close to $75 million, which probably puts us in the mid-range size for mix in Canada.
But if you got about, let's call it $65 million that you have currently out there in the marketplace. So I take my $50,000 as my TFSA, and I decide to go in and have a self-directed TFSA or RSP, and I give $50,000 to AP Capital. That $50,000 that I invest with you then gets amalgamated into the pool of $65 million that's lent out over how many mortgages?
Well, on this slide it says 1,000 mortgages funded, but that's the number of mortgages we've done since our inception. Today we have 256 mortgages in the portfolio. So when your $50,000 comes into the fund, into the pool, on the day that you are a shareholder, is the same day that you're now an investor in 256 mortgages. So you really have a lot of diversification across many different mortgages that are being paid monthly by those borrowers. Quite different than the one-to-one, and maybe we can talk about that a little bit.
Yeah, we'll circle back to that, but before we do that, I want to also touch on the fact that if I'm sitting there going, hey, this sounds fantastic, I can get a 7% return, but wait a second, how do you guys get 7% return when I'm only paying 3% on my mortgage? So let's pause for a second and really address the nature and type of mortgages you lend to, because obviously, I know you and I talked about this before. You don't like to call yourself a private lender because that's a different connotation. That's a different kind of definition, if you will. But you are lending to individuals who, for whatever reason, couldn't qualify at a bank. So the interest rates are higher that you're charging to the borrowers. So someone who's investing in your company is turning around, and you're turning around, taking that money in the pool and lending it out to other individuals who, for whatever reason, couldn't qualify at the bank. So the first thing that goes off my mind is, oh my God, what interest rate are these individuals paying, and who would ever do that? So why don't we talk a little bit about the nature of your clients, or the people you guys are lending money to?
Sure. And on this slide that's on the screen now, it kind of shows the wide range of interest rates for a Canadian. Now, none of us can go borrow from the Bank of Canada and get 1% interest rates. That's how the banks are trading in with an overnight rate between themselves. There is a cheaper interest rate on the far left. That's Bank of Mom and Dad, oftentimes 0%. Sometimes you don't even have to pay them back, right? But most Canadians are kind of familiar with that conventional mortgage rate world, which is influenced by prime. Obviously, if somebody goes with variable or fixed, they're kind of in that 2.5 to 3.5 today, right? There's credit cards, which most people know if you don't make the balance payment, you're going to be paying interest in the 20s. Payday loans are way off to the right. If somebody can't quite wait for their paycheck to come, they can go pay exorbitant interest rates for that. But there's an entire non-conventional lending world, and it's kind of depicted by this green box here, that's anywhere between 5 and teens of percentages. So interest rates, this could be commercial mortgages. These can be, lending just in the banking sector that's not residential. So there's a whole just non-conventional lending, sometimes also referred to as alternative lending. And this is the area where we act as a mortgage investment corporation. So to answer your question, well, who are these folks and why would they borrow from you at higher interest rates than from a conventional mortgage lender? The answer to that is that there's varying scenarios that Canadians can find themselves in, and some common ones are individuals that have a considerable amount of equity in their home. So they might have a home worth, and I'll just use simple math, maybe $1 million home, and they maybe have an existing mortgage, or perhaps it's clear title. Maybe they have a strong personal balance sheet, meaning they're high net worth, they've done very well in life, but if you switch over to the other financial statement in their life called their income statement, maybe it's not very strong. Maybe they don't show a lot of personal income. And if you today, in 2017, 2018, are not showing a considerable amount of personal income paid to CRA and taxes, so your NOA, your line 150, if you come from our mortgage world, those are common terms. But if you don't show a lot of personal income, it almost doesn't matter that you are high net worth or that you have great credit and that you have a strong balance sheet. The banks, the big banks, are becoming more and more challenging to deal with. And so many good quality
and as of January 1st, that's going to even get tougher.
It's going to get tougher. And so exactly. And so for many Canadians that are even, good credit Canadians, good balance sheet Canadians, just maybe don't show enough income, are finding it more and more challenging. And this is not going to just happen in January. We've seen this trend happen over the last 5 to 6 years where they're having to look for alternatives. So what might they need it for, or what scenarios might they find themselves in? We deal with a lot of folks that maybe have this equity in their home. They want to help their kids with a down payment. Maybe they want to expand their business, buy out a business partner. They see an opportunity in their life that they want to execute on in a quick manner. Sometimes there's folks that go through a divorce or face injury or some type of illness in the family and need immediate access to cash. The equity in their home is what they can turn to. And so often these are not people, and I always have to come back to this because I think the first inclination when people think about higher interest mortgages is, oh, those must be high risk borrowers. Those must be deals where people are, in dire straits or in really tough financial positions. And quite frankly, that isn't the type of people that we lend to because we have hundreds of mortgages out. We like to make sure that people are able to make their monthly payments and that when they're due at the end of their term, that they can pay us back. So we deal with good quality borrowers with good credit. And, certainly we deal with people that have maybe had bruised credit or different scenarios in their life. But this term, Peter, because we've talked often, we need to see an exit strategy. We need to know that we can be paid off at the end of the term of the mortgage. So, that was a lengthy answer to your quick question.
No, but there was a lot. This is really important because I think a key here is for the person listening to this webinar and asking themselves, does it sound like a good investment or something I'd be interested in? The first thing you have to ask yourself is, well, what's the risk? Because one thing is lending your money out, but you got to get it back. And I know for a fact, and I'll answer this question for you, you guys at AP Capital, a big, huge component of what the quality of what you have put together here is the strength of the underwriting. Our friend Brad Unruh is your head of your underwriting, and I know for a fact that one of the things he's looking at is, if I lend to this individual, would I want to own the asset afterwards? Because one of the things you have to think about is if the person that you're lending to doesn't pay you back, you're going to have to foreclose on that property, correct?
Correct. And that's why when we look at any deal that we will consider, we look in a kind of an order of priority. Our first and most highest priority is the property itself that's going to secure our capital, which is the investor's capital, this pool of funds. And so we look at independent as is property values. So this is why we don't lend on construction mortgages. We don't do speculation on developments or land deals or things where there is some hoped for future value. We lend based on as is today's verifiable property value. When we look at
for example, if I could come to you and I said, I'm going to do a land assembly, I'm going to take 3 houses on West First, put them all together, and if I tear these down and build a townhouse, I'm going to be able to pick them up for $6 million. But if I tear it down and build a townhouse, that's going to be worth 20. So can you lend me $15 million?
That's not a deal that AP Capital would look at. No, I mean, I think I maybe skipped past it on an earlier slide. We lend against single detached homes in urban areas where we can have an appraisal that we feel is a reasonable as is value today. And sure, the market might soften over the next year by 5% or 10%, but we lend to a loan to value where we feel like we can be buffered against a declining value that can occur. And we've seen very, hot housing markets in especially the cities like Vancouver and Toronto. So when we have 25 to 35% equity that is after us, we feel really confident. And I think we'll touch on that. I think it's the next slide where we look at our current portfolio of mortgages and where people as an investor can see, okay, I make my return, but how do I ensure that my capital is protected? We do that by making sure there's plenty of equity after we've lent money to somebody. But just before I get to that, I talk about the priority of looking at the underwriting, and you talked about Brad and leading our team. We look at the property first, and we look at the borrower. I want to say second, but we take a close look at the borrower. So often we see people that are business for self, meaning they don't maybe show as much personal income as what they might really have access to if they were to show full personal income. Instead, they maybe have retained earnings in a corporation. We do face some people that have financial hardship in their life, maybe caused by divorce, could be from illness, could be from, some people forget to pay a credit card and 3 months go by and they got a stain on their credit rating that takes them down 100 points, and everything changes in their life as a borrower. And sometimes we can see that, understand the story, feel that property is very stable in protecting our capital, and we'll lend to that person. And I already talked about the high net worth person versus the person maybe with personal income. So those are all just elements
people
in the
come to mind.
Yeah, for sure.
And when you look at that, so basically what you're saying is there's a wide variety of reasons why an individual would need to borrow from you rather than being able to qualify at the bank to get that money. Just one of the things I want to touch on, by the way, is again, this area. The more and more I talk to people is, have you ever heard of a MIC? Have you ever heard of borrowing from or investing into a mortgage investment corporation? I'm shocked at how few people really understand this vehicle. I'm a little biased. I think it's one of the most solid investment vehicles out there for your registered funds, whether it's RSPs or TFSAs. But I think one of the things I'd like to kind of just take a step back and touch on here, Ches, is the size of the market for this. Outside, because you're one of multiple MICs that are in the marketplace. How big is that marketplace of people looking to borrow money outside of banks and paying higher interest rates?
Well, I can just kind of speak to the MIC space in Canada. It's estimated that there's approximately $10 billion in MIC lending in Canada. I know that in British Columbia, it's closer to about $3 billion. Now, to just put it in perspective, let's look at nationally that number of $10 billion in the MIC lending space. The total residential mortgage debt in Canada is about $1.4 trillion. I always have to do the different math on trillion because that word is too much. So really that's 1,400 billion. So $1,400 billion of residential mortgage debt in Canada. And so the MIC space is 10 of that 1,400. So it's a big number at 10 billion, but it's not an enormous percentage. It's less than 1% of the total mortgage debt on residential properties across Canada.
Yeah, but you know what? I look at it from a totally different perspective. I look at this as an investor. There's a $10 billion opportunity on lending out there. And you might say, well, that's really risky. Not necessarily. If it's done properly, I would argue it's not that risky, but that's a $10 billion opportunity that people on this call have an opportunity to participate in, if you will. So the other thing I just want to touch on was you mentioned earlier the terms of your loans. So for example, obviously we didn't talk about interest rates, but the borrower would probably pay, and correct me if I'm wrong, between anywhere from 6 to 9% on a first mortgage and 9 to 12% on a second mortgage. Would that be accurate?
That's correct. Yep. Yeah. I mean, yeah.
And then what, 6 month or 1 year term?
So we write 1-year terms. We're considering 2-year terms, but really to date we've always done 1-year terms. We do offer renewals when we see perfect payment history and we still like the property. So about a third of our mortgages do renew. This slide here kind of speaks to the portfolio on September 30th. So if I can just touch on these quick points, I mentioned the 256 mortgages, about 70 million. So our average mortgage size is, north of $250,000 each. So again, if you kind of think about the diversification across 256 mortgages, we always have 1 or 2 or 4 or 5 that might be in a default or in foreclosure, but it's a manageable number. It's what we do every day. We administer the mortgages, we collect monthly, we deal with delinquent borrowers. We are, that's our job as a MIC operator. But we're focused primarily in British Columbia because we know the market out here well. This is where we're from. We feel comfortable here. We focus on residential only, and our primary sort of bread and butter business is on the single detached homes. Yes, we do some townhouses or properties that we just see, have great value for us. The loan to value number is a very important one. That's at 60%, and I didn't mean to jump over the 61% of our funds in first mortgages. So we do more. We have more of our money in first. Yeah, we have more of our money in first position than we do in second position. So we will put a second behind an existing first mortgage. But regardless, the loan to value across the fund, our target is 70. So that if there's 30% equity, but today we're actually at 60% loan to value, which means that there's close to 40% equity after our loans in the event of a softening real estate market. So we made a concerted effort over the last 2 years to really lower that loan to value because we do see a hot housing market, and we could see a decline of 5, 10, 15% in certain neighborhoods on certain product types. Now, these are only, 6 statistics out of the 21 that we report every single month. We email those to all of our shareholders every single month. It's posted on our website
that's your
monthly.
Fast Facts.
We call it our Fast Facts. That's right.
Right. So I want to touch on this a little bit. Okay, I'm going to go back. I'm going to keep circling back to this. I'm an individual. I got $50,000. I want to put it into I want to make an investment, whether it's my RSP or TFSA. So I throw $50,000 in there, and you've told me I could have a targeted return of 7%. Walk me through how that works, because where does that revenue come from, and how does it flow through back? Would you guys charge management fees? Because I'm not if I have a RSP second first mortgage and I'm lending to Bob Smith, and I give Bob Smith money on a mortgage, and Bob pays me 10%, then I get 10% directly from Bob. That makes sense to me. I can understand that. How does your program work? How does the flow of capital come back to the investor?
Right. So you mentioned before that we lend on first mortgages and seconds, and rates anywhere between, we don't do many at 6%, but maybe 7 on the low end, up to 12% on a second mortgage, you might say. So between 7 and 12. Now, we take a management fee for running the business, right? We look at a dozen deals a day, discard 10 of them, send out commitments on 2, fund 1. We pretty much do a mortgage every single day. We get payouts every single day. It's very, very active business. So we have a management fee for running this business. We charge 2.85% of mortgages under management as our management fee. So in order to generate a return to our investors of 7 or better, 7 plus 2.85 is, 9.85. Let's just call it 10%. We need to earn 10% on the top line revenue item in order for us to deliver a 7% return to our shareholders or better. Well, if we lend out money all day at 7%, well, we're 3 short and we're not going to deliver our 7 to the investor, right? So we have to see a blending. We do some at 7, some at 8, some at 11, some at 12. There's also fees. So let me touch on that a little bit. Fees are not present in the conventional mortgage market. If I go to BMO today or Scotia and I get a 25-year term deal or a 30-year amortization, I just pay my mortgage payment, and it's based on interest. The mortgage broker gets paid by the bank through some fee on the inside. Me as a borrower, if I am just borrowing from the bank, I don't pay an extra fee for my for my mortgage from Scotia. I might pay a fee to CMHC if I'm high ratio and I got to buy insurance.
Mm-hmm.
But in our world, we lend with interest rate and fees. So if we do a deal with somebody, and let's say it's $100,000 mortgage, we very likely are going to have anywhere from a 2 to a 4 point fee. And the 2 to a 4 point fee, maybe it's 1 to a 4 point fee, is often split between us and the broker. So that when the mortgage broker brings us the deal, he gets paid from that fee or she gets paid from that fee. And then the remaining component goes into the mortgage fund, or the first 1% of it. So the combination of interest rate on money plus the fee is what generates our, we'll call it top line revenue. And as I mentioned, we need to hit a top line revenue of at least 10 in order to hit, 7 for our shareholders. So, let me do some quicker math for you. Let's say we do a deal at 9% interest with a 3 point fee, and the broker takes half. He gets 1.5%. That's how he gets paid, the mortgage broker. So the remaining 1.5 comes into the fund. And if that's a 1-year deal, then the 9% money plus the 1.5 fee is 10.5, right? But if that person who borrowed the money from us pays us back early, well, the 1.5% fee actually ratchets up. The yield increases because we took the fee.
You can lend that money out again and earn that fee again. So within the 12-month period, you can lend that money out twice. Arguably, you increase the yield to the fund.
Correct. And, I know that I don't have a slide to back up these numbers. So for those that aren't maybe number people, I said a lot of things in a real quick hurry there. But essentially, coming back to the simple math on how do we generate a 7% return to our investors, we need to be lending out money and achieving a top line return of around 10 or better in order to achieve 7 or better to our shareholders. And so it's a matter of us having all of our capital out in mortgages. We also utilize our credit facility, which gives us some benefit, or gives our shareholders benefit as well. But all those things just come into play in us running a good, consistent and having the use of capital in play and fully utilized throughout the course of a year.
And Ches, if I'm a typical investor in my RSPs and I'm accustomed to working at the bank and getting mutual funds, that MER management fee comes off of my return. So if the bank says, we got you a 5% return, but there's a 2.5% management fee, then really my return is in my RSP is only 2.5%. So let's be clear. When you state a targeted return of 7%, that's net after all fees, correct?
Correct.
Excellent. So I just want to make sure that's really clear.
Yeah, no, and the other thing, and I don't know why, sometimes I get a little fee defensive. Fee defensive, that's a new term for me, because really,
you can trademark that.
The management fee is a term used in the finance world for fund managers, where they're actually taking a person's funds and then making decisions on where to put it. Whereas we're taking people's funds and actually running a full-blown banking business. And so I think it's a fairly unfair comparison to say, well, the MER of a mutual fund is X and your management fee is X or Y, and why is it higher or different? The businesses are dramatically different. And so, for folks that might be listening, they're like, I'm in a mutual fund that maybe has a MER of 1.5. It's just, I think it's something for people to consider.
Hey, listen, Ches, you know what? In my world, I really don't care what the management fee. I want to know my bottom line. And speaking of which, I just want to shift gears here and move on to another topic, because the biggest thing when we're talking about investing, there's two components everybody should be focusing on. Number one, what's my potential rate of return? And secondly, what's the inherent risk associated with that rate of return? Let's be honest. The higher the return, if anybody's offering you a 20% return, there's going to be a risk attached. Hello. So everything has a correlation between risk and return. Now, we've spent a lot of time talking and explaining, and you've done a fantastic job to help understand how that money flows through, and hopefully everybody has a good understanding now how a MIC operates. I really want to put a spotlight on the alternative to this. And of course, we talked about mutual funds, ETFs, other stock-related entities that you may invest in the marketplace, so to speak. But so this is just another option for you to look at. And by the way, it's a correlating asset to invest in, which means that it's not going to move up and down like the stock market, because the MIC operates as an entity, a company, like a bank, but it's not a publicly traded stock. So you are buying shares in the MIC, but those shares are not traded on a stock exchange. And we'll get back to liquidity question later. But what I really would like to touch on is the inherent risk involved in this compared to, for example, if I just took my money and lent it directly to Bob Smith, or if I'm in Ontario, there's a thing called syndicated mortgages, which are really popular. So what I'd like you to do, Ches, is explain the difference between lending, the risk parameter between yourselves versus one-on-one lending, and then we can talk a little bit about what is a syndicated mortgage and why is that totally different than what you do.
Sure. If I'm just an individual and I have, money in my registered funds or in my checking account, and I locate a friend, family, or stranger that just is in need of capital, and I place a mortgage on their home and my name goes on title, that happens across Canada. That's called private lending. And what happens in that space, it can work out well for people. The rates of lending are negotiated between the person who's lending the money and the person who's receiving it, the borrower. But it requires the person that's lending to be understanding of the underwriting process, to make sure that their money is, well placed, that they're really understanding the value of the home or the property that they're lending against. It requires them to understand that they're putting all their eggs in one basket, so to speak, all the risk on one mortgage. If things go sideways for them, I use the word sideways, meaning what happens if the borrower stops making monthly payments. If it's family, friend, that can be really challenging and contentious for people. If it's stranger, well, you can be a little bit different, right? But you really...
you can foreclose right away. But even if you foreclose, that doesn't mean you get your money back tomorrow.
Well, no, exactly. And so when everything's working just fine, and you have a saying for this one, Peter, maybe.
Yeah, it's always good until it's not.
Right. So when you lend money one-to-one, private lending, I lend money to a friend, family, or stranger, I receive their monthly payments at whatever the agreed upon terms are, maybe it's 12%, well, I'm earning that income until the day they don't write me the 12% return check, because either they don't want to, they can't, or whatever the case might be. Now I'm left not receiving my return, and I have to know what to do next. And it can become stressful to people if they have, most people have another job or commitments in their life. It's very distracting. And
or even worse, they're relying on the income.
They might be relying on the income. That certainly would be even worse. And they have to go through those steps now of dealing with a problem borrower. And, you can't necessarily deal with it in days or weeks. Sometimes it takes many months. So in our world, we have hundreds of mortgages at all times. We deal with this, right? We deal with borrowers that their payments bounce and we have to chase them. And then when we've chased them for, more than a couple days, then we start to notify our lawyers and we start to open, accounts with lawyers. There's legal fees. But that's our business. That's what we do. If I were to do that one-to-one, I have to find a lawyer that can help me do this. You can always find a lawyer, but it's going to cost me money. You might recover most of your legal fees, but you're going to wait, and there's time before, the foreclosure process takes its full course, and I get my money back and my return. So there's just risk inherited by being in that one-to-one private world. Many people have done it and done well with it, probably done well on the return side. But the one thing that is for certain is that you can never quite tee up your next deal when your existing deal pays out. So if I'm a private lender lending one-to-one and my current mortgage, gets paid out tomorrow on November 3rd or 4th or January 1st or 2nd, the chances of me putting the money back to work the next day or the next week is very low, because you have to go find the next deal. And so often what happens when people are in private lending is they do really well for the year that the money's out, and then they have to sit on it for 3, maybe 6 months, and then they find another good deal. And actually, if you just kind of netted out the return over time, they probably got around that 7-8% return. You know, because we faced a lot of investors. Go ahead.
And they've taken a significantly higher risk in doing so. And that's the big thing I want to emphasize for everybody on the call here. Risk versus reward. I cannot emphasize. If there's one thing you can get from this call, please write this down. When you land one-to-one, you cannot compare that to putting your money into a MIC. They're night and day. Yes, potentially you can get a higher return, but as Ches just explained, are you going to get that consistently over 24 months, 36 months? Because there's going to be some downtime where your capital is not working for you. Plus, you're exposed to the potential that you're just rolling the dice that somebody could get hit by a truck. There's so many reasons or opportunities or examples of where somebody could go into default. Perfectly good scenarios. Now, let's talk about that for a second, Ches. You guys aren't immune to that. People go into default with you as well. So out of the 256 mortgages, I think you touched on that earlier, what is a general percent of that portfolio that might be in default at any given time?
Anywhere up to 5%. So today we're right around 2% of the portfolio is in foreclosure, but it can be up to 5%. You know, and a person, you know, when you see a loan to value of 61%, I wouldn't be alarmed in a fund where you have that much equity protecting the capital if even a higher percentage was in foreclosure. So we like to keep
let's just say, for argument's sake, let's think of worst case scenario, because, you know, obviously as a private equity specialist, it's my duty and responsibility to everybody on this call to address the risks associated with an investment of this nature. What would you say is the absolute single biggest risk to AP Capital or to the investors in AP Capital in terms of what would have to happen for people to lose their money?
I think the biggest risk is just total housing meltdown in Canada.
Mm-hmm.
I mean, I can't.
In which case, we have a bigger problem.
Yeah, I mean, I can't look at any other element that would be the big risk for people's capital. Let me give you a couple other scenarios that could risk the return. So if we can't find good deals, well, then we're going to be sitting on cash in our account, not generating a return, therefore not putting people's principal at risk, but putting their return at risk. But really, the big risk of the fund, if you will, in our minds, is like rapid meltdown of housing prices in the urban markets of Canada. That means that the house in GTA or the house in Vancouver or the house in Calgary, and I'm not talking the high-end home that's listed for $9 million that suddenly sells for $6 million, and everyone goes, oh, the market dropped, 35, 50%, whatever the number is based on some, obscure property that had to take a huge haircut. I'm talking the average family home. If it takes a 40% hit in 1 year, you know that we have significant structural economic problems in our housing market in Canada. That would be the risk.
And I think we've talked about that. Yeah, and I think I mentioned that if that were to happen, we got bigger issues. One of the things, and we got about 5 minutes left on the call here. One thing I want to touch on, by the way, that Ches didn't mention, but I'll just volunteer this information because I know it for you. If the market were to crash by 30% or even 40%, because you guys have a total loan to value of the portfolio is currently 60.1%. So theoretically, there could be a 30% correction. You guys are still not underwater. But let's just say Armageddon happened and you had the worst case scenario. That doesn't happen just overnight. It typically happens over the course of 12 months. And in that time, your 1 year term renewals are coming up for renewal. So theoretically, you still would be okay because the portfolio a year from now will have completely turned over with new mortgages that are correlated to the new values. Is that your experience?
Yeah, no question. And, this kind of comes back to, we look at a dozen deals a day, we throw out 10, we discard 10 because we don't like them, and we issue 2 commitments in Fund 1. Go back to that example of the one-to-one underwriter or person. They don't have that volume to look at to, quote, cherry pick their best deals. But in our world, when we're doing 1 deal a day, we're doing that deal based on today's appraised independent values. And appraisers are very, in the residential world, appraisers are very, very in tune with the trending up or the trending down of the
very conservative
of the real estate market. And so when they look in a declining market, they start to, and they're doing these appraisals for us as the lender, not for the homeowner that wants to get the funds. That's a key element.
Yeah.
But they are, so we're doing a deal every day, we're doing it at today's new value. And if that is a declining market and the prices are dropping at, a couple percentage points a month, well, then the deal we're doing in a month from now is at a lower appraised value, at a loan to value that we feel comfortable with. So you're right. It does start to become adjusted based on a changing real estate market.
Absolutely. And folks, I always joke about this with Ches. As a mortgage broker, I hate these guys because they're too conservative. I want to make money as a mortgage broker, and I want them to do the deal. And they're like, nah, I don't know. We don't like the loan to value. It's like, come on, take a risk. No, we don't do it. So from an investor perspective, what I hate as a mortgage broker is what you should love as an investor because they're protecting your capital. Ches, we got just a couple minutes left here, and I did want to touch on one thing because, again, for everybody who's from Ontario, I get these calls all the time. It's like, well, I talked to this mortgage broker who's got me into this group of syndicated mortgages or whatever, and I can get 10% return. So why would I invest with AP Capital and only get 7%? So we talked about the difference between investing in a MIC, which is buying shares, you're not going on title, versus one-to-one lending. Touch on briefly, and we only got a couple of minutes here, but if you could briefly give us a quick example of what the difference is between a MIC and a syndicated mortgage.
Well, a syndicated mortgage is much more similar to the one-to-one. And instead of it being one-to-one where I find a friend, family member, or a stranger, it's you and me, Peter, lending, you, me, or 2+ people lending to a friend, family, or stranger. Typically, the syndicated mortgage offerings are originated or found by mortgage brokers and then brought to a base of 2 or more persons. Typically, most commonly, I would say, it's on, homes under construction, developments. It's not often the types of deals that we do, which is a single detached home that has lots of equity. It's still presented with equity, but a lot of times it's on construction or development type opportunities. And I wouldn't say it's all of the risks that are present in the one-to-one private, I think are still there in a syndicated mortgage. You just have to ask yourself. I go back to we look at 12 deals a day, we discard 10 of them, and we issue 2 commitments in Fund 1. If I'm an individual, either participating in syndicated mortgages or doing private mortgages one-off, do I have the same experience, the same knowledge, the same things to look for to discard 10 and pick 2 that I like? And so often you're presented something by a mortgage broker with good intentions, but it's presented in such a way that I don't have 12 per day to look at to throw out 10. I'm provided with something and I got to make a decision on it. And I don't have 4 others to consider maybe at the same time. So then I go with what I've been presented, and maybe I become a member of the syndication of that mortgage, and I face all those same risks that we talked about with the private individual. And
right, and if it happens to be a development or construction, and then the syndicate says, and the developer goes bankrupt, or you had to foreclose on it, now you got a bigger problem, because now as a group in syndicated, you have to own the asset. Correct.
And so all those same things we talked about happen. I mean, when all is good, it's good until it's not good. I didn't say it the same way as you did, but
it's always good until it's not. Listen, Ches, right. we're up on the clock here, so I just want to say thanks a lot for this. Has been fantastic. One thing we didn't touch on was liquidity. Just a reminder to everybody that AP Capital is not a publicly traded company, so as a result, if you invest, the idea is you're investing into this company so they can put your funds to work. If they have to have a constant liquidity strategy, then they got to keep money aside, and the more money they keep aside for liquidity, the less it's working to get that 7% targeted return back to you as an investor. As such, it's typically a 5-year hold is what you should think of this as. Now, you guys do allow liquidity, but there's a deferred service charge. You can touch on that very briefly. I think it's a 4.321 over 5 years.
Correct. Yeah, on the slide here, we talk about what we do in practice. We do redemptions on the first of every month. The offering memorandum specifies a little more of a restrictive in case there's a massive sort of redemption call from shareholders. We want to protect the existing shareholders, and so what's in terms of the offering memorandum protects the existing shareholders from a quote run on the bank, right? Because we're wanting to protect shareholders. But in practice, for the last 10 years, if somebody wishes to have their funds back and give us notice by the 15th, we make full payment by the first of the following month. There are redemption fees in those first 4 years, so people should be considerate of that, thinking of it as that medium to longer term. And I think I just had one other slide before the thank you. Maybe this one isn't so important, but we're Vancouver originated. We have an independent advisory board, couple gentlemen that keep us keep the corporate governance as though we're kind of like a public company. And
it's something we're skipping over that, but just so everybody knows, that's actually really important. It keeps everybody honest so that nobody's running off to Tahiti with your money.
Yeah, I mean, and the professional partners that we work with. I mean, we run a full professional business here with a team of people. And I think that's the difference. You're investing in a corporation that has a ongoing concern, a full day, operations. There's a dozen people that come into the office every day to make this business happen. We work with, a good size accounting firm with MNP. Our legal's done by a substantial law firm in town. We raise capital through, the investment dealers and exempt market dealers. They do an awful lot of due diligence with us. We look like a public company. When you buy shares from us, you'll receive computer share certificates. You can log in online, receive access to your current balances, see the monthly distributions happening into your account, either by the bank account or into your computer share account every month. And, our bank, which this is a key thing that for anyone that's still on the line, we have a substantial credit facility. We have to provide a bank a report to HSBC every month, and every quarter they come on premise and look through files to confirm the details of our reporting. So another layer of oversight to ensure that the company is operating as reporting. So I know we're up against the clock here.
That is significant for anybody looking, because listen, at the end of the day, if you're investing in anything, the first rule of investing is preservation of capital. How safe is this? Nothing is guaranteed. Nothing is guaranteed. But please, I just can't stress it enough for everybody on the line. There's a massive difference between lending your money to Joe Smith out there and saying, oh, I get 10% with all the risks associated with it, compared to purchasing shares in a company that's participating in a $10 billion industry and a great opportunity for you to take advantage of that and diversify outside the stock market and outside of the real estate market into participating in a $10 billion opportunity out there, and with all the inherent safeguards that Ches, you just went through. That's fantastic. I like the fact you guys have a targeted 7% return, and there's a lot of opportunities out there. You guys are looking to grow, right? Right now, there's more opportunity than you have capital for. Is that right?
That is correct. It's a very, very brisk business today. We're actively raising capital at a faster rate than we have in the past, because the opportunity is very substantial to us. So it's been a good 10 years, and we're looking forward to the next 10.
Fantastic. Well, Ches Hagen, AP Capital, thank you very much for being on the line tonight. This is extremely educational, very informative. And if anybody out there would like more information, please contact me directly at peter@peterkinch.com. Send me an email. Obviously, if you're listening to this, you have my contact information. Send me an email. We'd love to get you more information, answer your questions, and, of course, do a gap analysis to make sure that any investment you're considering is appropriate and right for you. And we'll just wrap this up with one last thing. If you live in the Vancouver area, just let me know if you'd be interested in a lunch and learn. Ches, you got great, fantastic offices downtown Vancouver here. You're open to doing a lunch and learn in the next month, yes?
Yes, absolutely.
Okay, fantastic. So if anybody would like to come down to the Vancouver offices and have a lunch on us, we'll buy you lunch and we'll educate you a little more and get your questions answered. Just send me an email. We'll let you know when that time is. And in the meantime, again, Ches, thanks very much. Any parting words that you have? Any last thing that you didn't get to say?
I think we covered everything, Peter. Thank you for the time tonight.
Fantastic. Okay, ladies and gentlemen, have a fantastic week, and we'll talk to you soon. And you know how to reach me for more information. Thanks, and bye for now.